There's the old adage, improving economy gives you improving markets give you an improving economy. You run a bit of a different beast here that could be a reflection more of maybe the inflationary environment too, or commodities and the appetite for them of all sorts. How do you look at that?
There's a lot of people that, because margins are still very, very thin, need to manage the risk of those products, and that's what we're seeing here. So whether that's a barometer for which way the economy is going to go or not, other than maybe people just don't trust up or down, so they need to make sure they mitigate that risk.
All right, Terry Duffy, of course, the chairman of the CME, and he was talking about how investors try to hedge their bets. Some place it in commodities after stocks have had a run-up, some vice versa. Let's go to Barron's associate publisher, best-selling author Jack Otter on these developments. Jack, what is an investor to do in an environment where, okay, I'm looking at commodities, I'm looking at how they could be affected by a trade war, also playing the soybean thing, I got to think of the stock thing. What do you tell them?
Well, starting with commodities, I think there's a lot of reasons to be somewhat bullish on commodities. Obviously, if you look at a long to mid-term chart, it's been awful. In the short term, there's been a bit of a rally, and I think that can continue. Often toward the end of an economic cycle, one of the last great bull runs are commodities, and the tariffs will just help those. And it's a nice hedge, right? If the GMs and the Boeings and the Deltas are all getting hurt because of either steel prices going up or oil prices going up, having a little commodity hedge is good. But speaking more broadly, I think today's number was a good number. There's a lot of the employment numbers are good. So short to mid-term, I think you want to be bullish on this stock market. You want to stay away from the bear plays like a long-term bond, because if we have a strengthening economy, possible boost in inflation, then the long-term bonds are not going to look good. Short-term bonds finally yielding something, so that's a nice place to hide.
A lot of people don't think in terms of commodities, do they? They look at stock should be in their portfolio versus bonds and cash, all that sort of thing. But it's like a blind spot for a lot of people. Should it be?
Well, I know a lot of financial advisors who don't mess with commodities either. They will tell you there's no earnings, there's no yield. It really is a trade more than an investment, and I get that. So I don't think you have to have commodities in your portfolio, but I think for people who are a little bit more trade-oriented, who are willing to take the right moment to maybe pare back your exposure, now is a decent time to be in commodities. On the one hand, anybody who'd been doing that in recent years has gotten burned, and that could certainly continue. So I wouldn't recommend it necessarily, but for those so inclined, I'm going to guess that now is a decent time.
I always try to get you to say something embarrassing and that could ruin your career, Jack.
Well, let's go for it.
And I've always failed. But the one thing that has come up is people are getting nervous about what's happening to Facebook, what is happening to Twitter, what's happening to technology. And then they've been led to believe, and history proves this out, that every time you've sold those issues or thinking that the sell-off will continue, you've been burnt, and if you had just stuck with them, you'd be rewarded. So there's this should I, shouldn't I kind of position on technology stocks in the aggregate. What do you say?
Well, a couple of thoughts. For one thing, if you have a broadly diversified portfolio, let's say it looks a little bit like the S&P 500, you're pretty heavy, those names on the screen right now, Apple, Amazon, Facebook, Microsoft, Alphabet. Those are a huge portion of the S&P 500. So I wouldn't necessarily try to chase them as individual issues. You've got exposure to them anyway, and if they get hit, your portfolio is going to get hit. It's been a little ugly. You know what concerned me was the Intel number. I mean, Intel had a pretty good earnings report, and that stock's getting hammered. I think with something like Twitter, well, they're finally making some of the house cleaning moves they should have made a long time ago. And so looking at the long-term health of that business, I think they're taking the right move. And it's up something like 45% this year. So yeah, it's been ugly in the last few days, but that's okay. Same with Facebook in some ways, right? This was a startup not so long ago, and now suddenly it's a great big mature company, and I'm not sure that Facebook really got the corporate governance thing going at the same speed that their market cap, that their power, that their economic leverage grew. So they're having growing pains right now. That's still an extraordinary company. and they've got the older folks with their Facebook, the younger people with their Instagram. I would not bet against Facebook. As someone who's in a business that's supported by advertising, I've seen how much Facebook is getting. That's a powerful company. Again, I'm not saying jump in. You've already got great exposure in your S&P 500 fund.
Yeah, and you've got that Instagram exposure too. Jack Otter, thank you. Always good seeing you, my friend. I appreciate it.